Stop hearing these uncle, aunties, and all these people like around you. Are they paying your bill? Are they building your credit? Are they fixing your credit? No. So don't stop listening to them. Never own something that owns you. I finally bought a Rolex. He was scared that I will scratch every day. He's scared that it's always gonna get dirty. He's like, do I wear it, do I don't? The watch owned him. At the end of the video, I'll be doing a giveaway, so stay tuned.
Good morning, George.
Good morning, good morning.
And good morning to all the viewers out there. Or good afternoon, actually, maybe. They're watching in a different time zone, could be. And today we're gonna talk about some basics. Because before anyone signing anything, sometimes there are some terms or like details that we don't actually understand. What's the logic behind it? So today we're gonna dig deeper into that. And let's start from the top questions. Like when someone get approved for a loan, how exactly is that interest rate calculated?
Okay, well, before we start, to all viewers, the last draw for the winner did not respond to our DM to get more details. So unfortunately, we have to redraw and we'll announce the new winner.
In previous episode, we talk about how lenders really concerned about risk of lending. So how does that actually translate to the actual interest rate the buyers are getting?
So as a certified credit analyst as well, it's very important. Our job and duty is to look at the profile or individual very careful in detail. For example, score, yes, a little bit, but again, if a lot of viewers saw a couple episodes earlier, it does explain the score itself. It's very minimal, okay, but it's more of the portfolio inside. Okay, nowadays with the whole AI and all of that, a lot of them it's very algorithm. Say for example, if this portfolio, a lot of them would be say these ones default more. If it's this category, they tend to actually pay on time, or this category completely just there's like repossession of vehicle. So a lot of data and a lot of statistics, and now a lot of times when financial business managers, or they call it F&I in dealership, when they submit, they submit and then let the computer kind of decide. The good thing is, yes, it's fast and efficient. The bad is still every portfolio is different. Every person's different, and is it a fair judgment to then let a computer decide on that? Right? So for example, I actually had a client, I'm not going to name who due to privacy, came in with a really like low fives, almost like high 4 score. And with a over, if I remember correctly, like 130 or 150,000 in debts. And what it was is marriage problem. The husband cheated on her. It was abusive relationship. Then she had to file a, separation divorce. And then the man actually left all the money behind. And then she has no choice to file consumer proposal, stuff like that. Now, in probably all the viewers, right? A lot of banks or lender, when they see it's like, whoa, score, file consumer proposal, all payments late, they're like next. Because they rather lend to someone that is not, right? But then again, how is that fair, right? Because not knowing the story behind it, right? And not to be very discriminated or not to be very judgmental, well, then you need a person to talk to understand that situation, to explain, well, what happened, right? So to answer the kind of the interest rate, it's a lot where meaning on your Equifax there's a section called clean, mature, or thick. Clean would be making sure that all your payments on time. Mature would be relating to your credit history, how long you've been building your credit, since X amount of years, whether it's 5, 10, 15. And thick is basically your inquiries or your credit cards, student loans, auto loans, stuff like that, right? So all that is put into or measured. What is the risk?
Yeah.
Then that risk is equals to, then again with their data and all that, each lender is different. That would equal to, I think with this interest rate, what makes sense. Meaning, if the credit profile is strong, it's good and healthy, rate is lower because it's a tendency of client will always pay on time or will pay full, or if not pay more. Even including myself, we do call it in the mortgage, we do accelerated pay.
Yeah.
Right, so a lot of people do monthly, we chose the weekly. We actually put more than what was even sometimes agreed for, right? So all these matters, and that's where then the lender comes back dictating as a whole what is the interest rate. So in the event, if knock on wood something were to happen, they are still okay, they cover that.
I see.
Yeah.
When you mention accelerated payment, is it one of the means to kind of lower the interest rate?
No, so accelerated pay, so a lot of times, actually majority of Canadians do, monthly mortgage,
Yeah.
stuff like that, even auto loans sometimes bi-weekly or monthly. Accelerated meaning, instead of monthly, we do weekly.
Oh yeah.
Okay, and that weekly meaning the faster you pay, because it's always principal and interest. Interest is on the principal. So the principal comes down, your interest, whatever the balance, then also comes down. Right, so then your term will be shortened because you're in accelerated pay, right? And stuff like this, obviously, banks and lenders love it, right? You're not like really waiting till the end of the month. Not that it's a big deal because that's what the agreement is, right? But you're doing above and beyond. Yeah, what I mean?
Is it the same as open loan when you can like pay off the loan? Like,
yes, but in mortgage, there's each lender has a different kind of a rule because look, they lend money, they want to make money. If today you won the lottery and you pay it off, then they're like, okay, then what did I make? So they put a penalty. You cannot pay X amount over. So normally lender capped it at 40%. Okay. So for example, if this year was agreed to pay, your monthly is like, 2,000, 40%, okay, you can pay extra 800. You can pay more. You pay more, then they lose that interest or money that they plan to make. But again, all lenders different. Some are lower. I've seen like 20, 25. Really depends. It really depends.
So always check with your lenders, right? So from a consumer perspective, what are the things they can actually do or control on that side to kind of like lower the interest rate?
Imagine, after a long time, many years, now I want to come to buy a house. I want to borrow $500,000. But throughout the years, I've already been borrowing 300, 400, always pay back on time, if not earlier. That trust is there.
Yeah.
That trust is there, right? So the answer again, no. A client, there's no control, nothing you can do the day of your planning. It's based on, it is what it is, right there, that situation.
I see. So that's why we say it's like a building process instead of like a one-off, like a fast pass method that you can get for like a perfect credit, right?
There you can and there isn't.
I see.
Yeah.
So the next question I have would be more car dealership specific. So for as a consumer, when you go into the dealership, you always go to the website and see the price for it. But the price, we call it a sticker price. It shows on the car, it shows on the website, but it's different from the actual payment because the actual total you end up paying once you factor in like taxes, fees, and the cost of borrowing over the full term. So there's a difference in prices. Like, can you break down what goes into that final numbers?
Yeah, of course. So every province has a different, you could say a third party that governs these type of dealership to even advertising marketing. So in Ontario, it's OMVIC. In, I believe, Alberta is MVIC, right? You have to check. I mean, not all province or countries or have the same, but it is to mainly protect the consumer for false advertising. So leading to that, what it means. So right now, whatever you guys see online, at least here, again, I don't know about your country. Here is what you see. That's exactly the price plus taxes, HST, and whatever fees you're supposed to put. So meaning it's clean, it's clear. If a client goes in, it's just buying cash. So that's the cash price.
I see.
Okay. When then you go in, well, I mean, either you have cash or you don't. If you have cash, then you just make a bank draft, and then that's off. Then you buy, here you go, and then off you drive. Those numbers is only when you're financing it, or even say when you're leasing. So in dealership, the MSRP price, again, that's the price. Now, whether you want to lease, whether you finance, up to you. Both same. Numbers different because lease is usually X amount that you're leasing. So a lot of people know it's like kind of like renting. You got to return the vehicle, right? Leasing makes sense for a lot of usually like realtors, mortgage agents, people that travel quite a bit. They usually lease 1 to 2 years because the kilometer's going to rack up, and then here you go, they need a new one, etc. Right? Or most people chose that route for payments because payment is a lot less than finance. Because finance, you'll be financing the whole entire amount. Leasing, again, is only X amount, right? Now, to break that down, so now you have to add the price. All the admin fee, lender fee, OMVIC fees, whatever fees entail. Some dealer charge PDI, OTS, etc., etc. Then on top, if there's warranty or not, and then there's cost of borrowing, and then the taxes. That's when then you also would see the terms and the rate, all of them included, which is then equally at the end, what's your bi-weekly or monthly.
Okay, so as a consumer, should I pay monthly or weekly? Is there like a very big difference?
No, auto loan is not unlike mortgage. Auto loan, we're talking about like $20,000, $30,000, $40,000 vehicle or so on average, just to say. House different, right? Talking about over $500,000, right? So whether you do weekly, bi-weekly, monthly, it doesn't really affect much because finance, it's open. Leasing is a closed. Right, so lease meaning you lease 4 years, you got to do 4 years. I mean, you can still breach a contract, but you have to pay for all the interest, etc. Finance, where different. If I bought the vehicle today, 2 days later I won the lottery, I can just pay it off. There's no penalty, no final fee. You can literally just call the bank, what's my balance? Boom, just take all the money out. Done. Right? So, definitely different. At the end, the number's quite the same, especially for the first 2 years. It's more paying on the interest, not so much on the principal. So it's a more personal preference. If you can do weekly, bi-weekly, semi-monthly, monthly, up to you.
So it's a personal preference thing.
That would be personal because it doesn't really affect that much or a lot compared to a mortgage.
So next I want to talk about term of loan. So for someone who has never financed anything before, what does the term actually mean? Like, does the length of the term affect the final price that we pay for whether it's a vehicle or...
No, the term is just basically the longer the term is, a lot of people feel and believe, okay, then I'm paying obviously the interest, right? Yes, it is true. It is true. That's why, there's called the accelerated pay and all of that. But at the end, again, it's really come down to your budget, right? It's no difference. Let's just, for mortgage, let's just say $1 million house, right? Or even say a mortgage. Make math easier, $1 million mortgage. You want to do like what a car loan always do. People, I only want to pay like 3 years, 4 years, or whatever. Just do simple math. 1 year. You better have over $120,000 on the bank every month. I don't think
Which
a lot
is
of people are
not
able to do that.
possible.
Exactly.
Yeah, for
you
me at least.
because if you have that money, then just might as well buy cash, right? You
Yeah,
won't even need
yeah.
to mortgage,
Yeah.
right? So same thing with car, right? Some people would say, oh, jokingly, if you can do 100 years, oh, I can guarantee your monthly payment for a car is like 50 cents probably,
Yeah.
right? But there's no such thing. So it really depends again on your budget.
Yeah.
If, you know, and that's why people in mortgage do 25 years, 30 years amortization, right? Because they stretch that payment
Yeah.
as long as you can, as long as, or as much as they can,
Yeah.
so that the payment is more quote unquote affordable,
Affordable for them.
right? So for car loan, term is just a lot of people, oh, you know, the 4 and the 5 and all that. Stop hearing that old school mindset.
Yeah.
Stop these social media stuff and all that. Just really, it's you yourself. You're the one who's paying. Not your mom, not your cousin, not your friends, not your family. Oh, I owed it 4 years. This is my rate, whatever. Okay, but that's not you though. Right? Do you work in the same job, same age, same title, same credit? Like everything has to be like identical to the same thing. Right? Which is, there's no such thing in this world. Right? So it's really something to all viewers. You have to just figure out yourself what you can truly afford. If it's finance, it's already an open loan. If it's an open loan, then hey, if you have the money, if suddenly you just want to pay the, call the bank. I want to put in another 5,000, 1,000, or weekly. Can you change my payment to a little bit higher?
Yeah, yeah.
You have all that power to do so.
It's pretty flexible, right?
Extremely flexible. Then just do that, right? Stop hearing these uncle, aunties, and all these people like around you. Are they paying your bill? Are they building your credit? Are they fixing your credit? No. So don't stop listening to them, right?
Yeah. So there's actually no sweet spot when it comes to like the terms of loan, right?
There isn't. It's all personal preference how you want to do it and how you know, it really your financial basically comes down to.
What is the shortest and also the longest term that the bank
Shortest term,
offer?
it really depends on the year. So in finance right now, we're in 2026. I know some lenders can go low as 2016 or 17. Anything lower, they just don't finance because it's not worth it,
Oh yeah,
right? The longest is 96 months.
96 months.
Yeah, which is 8 years.
Oh wow.
Yeah.
Okay, I see.
But again, I always, 7 years, 8 years, 4 years, who cares? Look at it as, again, like a mortgage. Look at your affordability. If at the end your financial can be better, you got a promotion, whatever, then either put a lump sum, cut down the term, right? Or add some more to your bi-weekly, semi-monthly, or monthly payment. Cut it down.
I see.
It doesn't matter. Why stretch yourself so hard just because of someone on your ear telling you? Right? A lot of people give me the same feeling, like, oh my God, 8 years, like, oh my God.
Yeah, because people are saying like, if you are stretching the terms of loan that long for a vehicle, vehicle is kind of like depreciating assets. So you stretch your loan for that long, paying something that's going to depreciate eventually, that's not like a smart financial move.
A lot of times, actually, a lot of clients don't make any smart financial decision.
Yeah.
Because car is an emotional item,
Oh yeah.
right? They look at it like, ooh, it's
Yep.
manual. Oh, it's a sport car. Oh, there's letter C. Oh my God, it looks like a little iPad, and those are all emotional buy,
Okay.
right? So a lot of times I tell clients, don't bite more than you can chew. Meaning, really at the end, it's just point A to point B. At the end, you're following the same rules of everybody following on the road.
Yeah.
How faster can you truly go?
Yeah.
Right? I always tell friends, if we go for dinner, okay, you're 2 minutes early. Well, guess what? You're still gonna sit here, wait for me to arrive to order
Right.
anyways. So then who cares, right? One thing that I've learned from some people too, I mean, it's again, personal preference and depending on your financial. Never own something that owns you.
Oh yeah.
Own something that you own. So there was a clip in media, a guy talking about I've saved so much money. I finally bought a Rolex,
Yeah.
and what turned out was he was scared that I would scratch every day. He's scared that it's always gonna get dirty. He's like, do I wear it? Do I don't? The watch owned him because took him all the time to save up the money. Finally, he got a Rolex, kind of like an identity, right?
Yeah.
Some then say, well, I mean, if you can truly afford it, truly own it, you wouldn't be really that scared.
Yeah.
Which is true, right? Do you think Jeff Bezos or Elon Musk, you think they're like, oh, we'll just get a new one, right?
Okay.
So, car, yes, in general, it is a depreciating product, but also depending on the market.
Yeah.
Because when COVID came, we all know, due to the microchip problem and all that, the used car market actually price went up a lot.
Oh yeah.
A lot of times, and this is unheard of. It's very rare this happen. You lease a vehicle, you're supposed to give it back or owing a balance.
Yeah.
Dealer were willing to pay the full and on top give you money
To buy your car?
to buy the car because the demand was so high.
Yeah.
So now, is it a depreciating product?
Yeah.
Depending on the market, right? Depending on the market. But I think just really honestly, just point. Be practical.
So pick something that you're like fully committed to.
Financially
Yeah,
comfortable. Financially makes sense.
Yeah.
Really financially makes sense. If you honestly can afford a Lamborghini, buy it. 100%. Get it. If you can truly afford, when I say afford, not only just the payment, the insurance, you can go back to the dealership, do an oil change, which costs like $2,500, $5,000. Like, it's that comfortability. You're not driving a Lamborghini and bring it to like some third party, mechanic, and then they just do an oil change. Like, you're just showing off.
I see. So for someone watching this who is about to buy their first car or first property, what is that one thing that you want them to walk away with, knowing from today's our conversation?
Mortgage is a little different.
Oh, yeah?
But auto for first time buyer, first time purchasing or finance. Back to my previous episode, really just when you talk to the person, do you feel this person is honest, transparent, has integrity?
Yeah.
Do they really try to explain and educate you, or they're just trying to sell you?
Yeah.
Right? Car wise, I would tell them don't be such a stickler on brands. This is one thing I'll tell you all viewers. A lot of guys like, oh, it has to be Honda, Toyota, because yeah, it's a go-to brand. But not necessarily all brands or certain brands is perfect. They all have recalls, they all have their own issue.
Yeah.
Do your own research, okay? House, same thing. All I can say, it's a little bit different, but first time home buyer, really making sure, hire a very good home inspector. Really like dig deep and inspect the house.
Yeah.
Once you grab the key, that's
There's no
it.
going back.
Like if you find something after, like the transaction is done.
Yeah.
Okay, you can't go back, right? So I think me personally, just really who you want to work with, that person, do you feel that honest integrity and transparency? That is money you cannot buy.
Alright guys, it's time to announce not one, but two giveaway winners this time. First of all, we have our March redraw winner here. And the winner for March giveaway will be... Congratulations! And next up, we will have our April giveaway winner. And for April, here we go. Congratulations to the second winner. To both winners, please DM us on Instagram so that we can get your details and send you the prize over. If we don't hear from you, we'll have to redraw, so don't miss out. And keep commenting, keep sharing the videos so that you can enter our May giveaway.
End of the month, I'll be giving away $200 cash to one lucky person. All you have to do is like, share, subscribe, and comment and tell me what the money is towards. Let's build a better credit together.